Welcome to the Deep Dive. Today, we're plunging into a world that's, well, familiar to millions. The universe of that green siren, Starbucks.
It's a siren, yeah.
For so many of us, it's not just about the coffee, is it? It's that daily ritual, maybe a go-to meeting place, sometimes even, our office away from the office.
Absolutely. It's woven into the fabric of daily life for a lot of people.
But beneath that polished surface, the cozy chairs, the hum of the espresso machine, what's really going on with one of the world's most iconic brands?
That's a great question because while it seems simple on the surface, coffee, right, there's this fascinating duality at the heart of Starbucks Corporation. That's SBUX for those tracking.
SBUX, okay.
We've been really digging into a pretty detailed report on its business quality. Lots to unpack there.
And our mission for you today is, well, to cut through the noise, pull out the really important insights, and help you understand whether Starbucks truly remains what you might call a wonderful company for the long haul. You see, the big tension we're going to explore, the real core of it, is this. Can Starbucks successfully be both things at once? Can it be that premium theater, that inviting third place in an efficient factory designed for speed and high volume?
That's the tightrope they're walking.
Exactly. So we'll explore its strengths, its current challenges, and how this central conflict really plays out across the entire business. Let's get into it.
Okay.
So let's start with the business itself. On the surface, Starbucks just sells coffee. Seems simple, but they've somehow turned this, common commodity into a multi-billion-dollar enterprise.
Yeah.
How do they manage that? What's the engine here?
You've hit on the core insight right there. It's not just coffee. Starbucks has this ingenious, you could call it a three-stream engine for making money.
3 streams, okay.
Yeah. The vast majority, like 82% of revenue, comes from the stores they operate themselves, company-operated stores.
Right. The ones we mostly see.
Exactly. And this gives them direct control over the brand, the quality, and that really crucial Starbucks experience. That's what lets them charge more, right? It justifies the premium prices. It's their direct line to the customer. The theater in its purest form, you could say.
Okay. Direct control. That makes sense for the majority. So what about the other 2 streams? You said 3.
Well, the other 2 are smaller, yeah, but they're strategically vital. About 13% of revenue comes from licensed stores.
Like in airports or Barnes & Noble?
Precisely. Airports, universities, grocery stores, places like that. It's a capital light model for them. Partners open the locations, Starbucks gets royalties, and they sell them high-margin products like the beans and syrups. It's low-risk expansion.
Clever. And the third?
The third is channel development. That's about 5% of revenue. This is where they make the brand just everywhere. Packaged coffee in supermarkets, K-cups, those ready-to-drink frappuccinos.
Oh, yeah, you see those everywhere.
Exactly. Often through big partnerships like their global alliance with Nestle. But the real secret sauce, I think, across all 3 streams is commanding that premium price. It's way above the actual cost of the coffee and milk. That leads to really high contribution margins on pretty much every sale.
That premium price, the experience.
Yeah.
That brings us straight to this idea they basically pioneered, didn't they? The third place.
They really did.
We've all felt it, right?
Yeah.
That comfortable, welcoming spot that's not home, not work, it's somewhere else. How do they elevate coffee into something so much more than just, caffeine delivery?
Well, it was very intentional. They meticulously designed the stores, the cozy furniture, the free Wi-Fi back when that was novel, the warm lighting, the music.
Yeah.
It was all designed to create this versatile social hub.
Right. To make you want to stay.
Exactly. It truly decommoditized the product. And if you think about why that lasts, why the third place or the theater idea is durable, it's anchored in something really simple. The coffee ritual. That daily or weekly habit.
A habit people don't give up easily.
Not easily. Plus, you've got growing global demand for specialty coffee, especially in emerging markets. And maybe even more fundamentally, this timeless human need for connection, especially now, right, in our super digital world, that physical third place becomes almost more valuable.
That's a great point. And the fact they've been around for, half a century? That speaks volumes about adaptability.
It really does. 50 years is a long time in retail.
Okay, so that's the business model, the third place concept. But how do they protect it? This is where we talk about their competitive fortress, their economic moat. The analysis we looked at points to 3 main layers here. What's the primary one, the one that really lets them charge those higher prices?
Yeah, the moat. The biggest piece undoubtedly is their intangible asset, the brand itself.
Just the logo, the name?
It's more than that, but yes, starting there, Starbucks is one of the most recognized consumer logos on the planet. It's just synonymous with premium coffee with a consistent experience wherever you go. And that gives them incredible pricing power.
Pricing power. You see that in the margins.
Absolutely. Look at their gross margins. Over the past decade, they've averaged a superb 28.3%. That's evidence right there. It's not just about the taste. I mean, the coffee's fine, but it's about the feeling, the routine, the emotional connection they've built.
At emotional leverage, yeah, I get that.
Mm.
But how does their sheer size play into strengthening that brand and the business?
Oh, scale is a massive advantage. Huge. Think about it. Over 38,000 stores globally.
Wow, that many.
That many. And that gives them enormous purchasing power. They can negotiate better prices from suppliers for everything. Beans, milk, cups, you name it.
Okay, buying power. What else?
They can also spread out huge investments. Things like technology development, building an app, for instance, or massive marketing campaigns, or managing their global supply chain. They can spread those costs across that huge revenue base. Smaller competitors, they just can't match that efficiency.
Right. Amortizing costs over thousands of locations makes a big difference. And then there's the digital side. The Starbucks Rewards loyalty program seems like a monster competitive advantage.
It absolutely is. Over 75 million global members. That's incredible.
And it drives, what, almost 60% of sales in U.S. company stores?
59%. It's staggering. It creates this incredibly powerful flywheel effect.
Flywheel. How so?
Well, more members mean they get more data. More data leads to better personalization, customized offers, marketing, even influencing new product development. That enhances the customer experience, which drives more loyalty, which brings in more members or gets current ones to spend more. It just keeps spinning.
And it makes it harder to leave, right?
Exactly. There's a soft switching cost, as the analysts call it. Who wants to give up their accumulated stars, their free birthday drink, their personalized offers, or even just the convenience of having your regular order saved and ready to go with a tap? It keeps you locked in a nice way.
Yeah, velvet cage of convenience.
Right.
But okay, this raises a really important point. We talked about pricing power. What are the limits? Because personally, I feel like I've seen those prices creep up a lot.
You're definitely not alone in noticing that. And we've seen a real-world stress test recently. The analysis pointed out that the average price of a grande brewed coffee, just a regular coffee, is up 49% since 2020.
49%?
Yeah, it's a massive jump. And that, combined with just general inflation everyone's feeling, seems to have hit a tipping point.
Meaning people are pushing back.
It looks like it. Starbucks has seen recent traffic declines in the U.S., fewer people coming through the door, and what did they do? They started rolling out promotions again, buy one, get one free deals, bundled offers, things you didn't see as much when things were booming.
Trying to lure people back in.
Exactly. It's a crucial lesson, right? The Moat allows premium pricing, sure, but it's not infinite. If the gap between Starbucks and, say, McDonald's coffee or making it at home gets too wide, people start trading down. The factory pushing for efficiency might be clashing with the theater's perception of value.
So putting this all together, the moat, where is it heading? Is it widening, narrowing, staying the same?
The assessment calls it stable, but definitely facing significant pressure. There are forces working both ways.
Okay, what's widening it? What's helping?
On the one hand, you've got the continued growth of Starbucks Rewards. They have a huge goal. Double members from 75 million to 150 million in 5 years. That strengthens the digital network effect.
Double it. That's ambitious.
Very. And then there's international store growth. The ambition is to hit 55,000 stores globally by 2030.
55,000. That's 8 net new stores opening every day.
8 per day, on average. That certainly adds to their scale advantage, widening the moat in that sense.
Okay, but on the flip side, what's chipping away at it? What's narrowing the moat?
Well, there are some powerful forces there, too. Intense competition, especially in China. Luckin Coffee is a major challenger there. Very digitally savvy, lower prices.
Right, I've read about them.
And then back in the U.S., you have those foot traffic declines we mentioned, this sort of general feeling, this perception that the in-store experience isn't what it used to be. Plus, declining gross margins are putting pressure on profitability.
And all this pressure points directly to?
It points directly to the strategic pivot under the new CEO, Brian Niccol. He's known for being very operations-focused.
From Chipotle, right?
Exactly. The big question, the one hanging over everything, is whether his intense focus on throughput, on optimizing the factory, could inadvertently damage that third-place ambiance, that theater, which has always been a cornerstone of their brand and their moat.
Okay, to really get a feel for that, we need to go beyond just the financial reports. We need to simulate what investors call scuttlebutt, basically, listening to what people on the ground are saying, customers, employees.
Yeah, getting the qualitative side.
On the customer side, it seems like there's this weird split, doesn't it? Like, incredible brand love still exists, but there's also this growing frustration, especially about price. How do those two things coexist?
It's fascinating. Globally, the brand is still deeply loved. People associate it with quality, comfort, consistency.
Yeah.
If you're traveling, finding a Starbucks can feel like finding a reliable beacon, right?
Totally. It's a safe bet.
And that rewards program, as we said, is highly valued for convenience and feeling like you get something back. But, and it's a big but, there's a growing chorus of frustration.
About what specifically?
High prices are number one for sure, but also a lot of complaints about the in-store experience declining. Customers describe stores as feeling, well, chaotic, noisy, crowded.
Why is that, do you think?
A lot of it seems driven by the sheer volume of mobile and delivery orders. You know, the pickup counters are overflowing, the baristas seem stretched thin, trying to manage multiple order streams. It can feel less like a relaxing cafe and more like a shipping hub sometimes.
Yeah, I've definitely felt that. You go in expecting that quiet third place vibe, and instead you're navigating a crowd waiting for delivery drivers.
Right. It's a real shift from that original promise. And the fact that management recently ramped up promotions, that's a clear signal. They know this friction is real and it's impacting how people behave.
Okay, so that's the customer view. What about the partners? That's what Starbucks calls its employees. On one side, you hear about industry-leading benefits.
And they really are. Comprehensive healthcare, Beanstalk, which gives them equity, the college achievement plan for tuition. These are genuinely impressive, especially in the retail and restaurant world.
So, given those great benefits, why are we hearing so much about high stress levels, feeling overwhelmed, and even this significant push for unionization?
That's the core contradiction, isn't it? The benefits package is top-notch, but the day-to-day reality for many partners seems incredibly intense.
Also,
if you look at employee forums or news reports, you hear stories of understaffed stores, relentless pressure to hit drive-through time targets, get cars through in under X seconds, and just this general feeling that the job has shifted. Less craft barista, more, well, fast food level work, as some put it.
Wow. That's a stark contrast to the brand image.
It is, and this operational pressure, the sheer demands of the factory side of the business, combined with sometimes feeling disconnected from corporate decisions. Those are major factors fueling the unionization movement we're seeing across hundreds of U.S. stores now.
So Starbucks invests heavily in partners, on paper, with benefits.
Yes, significant investment.
But the operating model itself creates this high-stress environment that then impacts morale, hurts the customer experience, and ultimately could even damage the brand's health long-term.
That seems to be the dynamic at play. It's a tough balance.
Which brings us right back to that central conflict we keep talking about, the theater versus factory dilemma. It feels like the core issue for Starbucks right now. Can you just walk us through how these two kind of opposing forces are clashing inside the business?
Absolutely. Let's break it down. The original Moat, the magic, the theater, that was built on the idea of a premium, relaxing third place, a place you wanted to linger. That justified the higher price.
The cozy chairs, the Wi-Fi, the ambiance.
Exactly. But then came the explosion in mobile ordering through the app and the growth of drive-thrus. These shifted the business's center of gravity towards the factory.
The factory being speed, convenience, throughput.
Precisely. Getting orders out fast, handling high volume. Now, this factory focus has been a huge engine for revenue growth, no question, but it's created this negative feedback loop.
How does that loop work?
Well, you get this surge in highly customized mobile and drive-through orders, right? Think about those complex drinks people order. That creates long queues, both physical and virtual. It stresses out the employees trying to juggle everything.
Okay.
And that, in turn, degrades the theater experience for the customers actually in the store. It's noisy, it's busy, the barista doesn't have time for that quick chat. And ironically, it can even frustrate the factory customers if their mobile order takes forever because the system is overloaded.
So basically, trying to be both is making it hard to be great at either one.
That's the risk. That's the tension.
And this is exactly where Brian Niccol, the new CEO, steps in. His whole big fix plan seems like a direct attempt to tackle that factory side. What's he actually doing? What are his first moves?
Well, his initial actions are very telling. Simplifying the menu, fewer complex options maybe, focusing intensely on service times, aiming for under 4 minutes apparently, and restructuring parts of the corporate organization.
All aimed at efficiency.
Squarely aimed at improving efficiency and throughput, making that factory hum. He wants to grease the wheels.
So, okay, the absolutely critical question then, especially for anyone thinking about this as a long-term investment, is can this factory optimization actually be done without, tearing down the theater?
Yeah.
Without destroying that unique brand differentiator that Starbucks built its empire on?
That is the multi-billion-dollar question. Precisely. The market, judging by the reaction to his appointment, seems to be betting that yes, he can thread that needle, but it is a significant risk. It could fundamentally alter the moat's durability.
Let's shift gears a bit and talk about leadership and how they manage the money capital stewardship. The big news, as we mentioned, was the leadership change. The abrupt departure of Laxman Narasimhan and bringing in Brian Niccol. It really feels like a dramatic strategic pivot. Some are calling it the Chipotle-ification of Starbucks.
It really does feel like that, a very sharp turn. Narasimhan, who was only CEO since April 2023, seemed really focused on culture, human connection, his whole reinvention plan. He emphasized the brand's heritage, the theater aspect.
And Niccol.
Niccol is different. He's a proven turnaround guy, right? From Chipotle, before that Taco Bell. He's not a coffee industry lifer. His whole reputation is built on operational excellence, digital transformation, menu innovation maybe, what relentless focus on throughput and efficiency.
So less about the warm, fuzzy feelings, more about the nuts and bolts.
Exactly. His big fix, or back to Starbucks strategy, whatever they call it, is clearly prioritizing operational fundamentals. He brings this data-driven, analytical, highly accountability-focused approach. It's like bringing the intensity of a top-tier fast food operator into the Starbucks world. He's definitely here to tune up the factory.
Okay, so that's the leadership shift. How has Starbucks historically managed its cash? Their track record on capital allocation seems very focused on shareholder returns. Where does the money primarily go?
Yeah, the primary use of cash is definitely reinvestment back into the core business. You see that in capital expenditures. They bumped it up from $2.3 billion in fiscal 23 to about $2.8 billion planned for fiscal 24. That's mostly for building new stores and renovating existing ones.
What about buying other companies? M&A?
Not really a big part of their strategy lately. They've actually been selling off some non-core assets, and past acquisitions like the La Boulange bakery chain years ago had kind of mixed results, so it's not their main focus.
So reinvestment first. What about returning cash to shareholders?
Oh, they are very committed to that. Aggressively so. Dividends, for instance. They have an amazing record, 60 consecutive quarterly payouts. And the dividend has grown at nearly 19% per year over the last 15 years. That's huge growth. They plan to return about $2.6 billion just through dividends in fiscal 24.
60 consecutive quarters, wow. And buybacks. They do a lot of share repurchases too, right?
They do. Very significant buybacks. They repurchased $1.3 billion worth in fiscal 24, and that was part of this larger multi-year plan to return $20 billion to shareholders through fiscal 24.
Okay, so reinvestment, then big dividends, big buybacks. Sounds pretty shareholder-friendly on the face of it.
On the surface, yes. It generally looks like a rational, shareholder-friendly approach. Fund organic growth first, then return the excess cash. However, there's a nuance here, a critical point from the analysis.
What's that?
These aggressive returns, the buybacks and dividends, haven't just been paid for out of free cash flow. They've also been funded by taking on a significant amount of debt.
Borrowing to fund returns.
Exactly. Now, they did prudently decide to temporarily suspend buybacks late in fiscal 24, which suggests they recognize the pressure. But the sheer scale of these past returns, funded partly by debt, definitely has implications for their financial resilience going forward.
Okay, let's look at the financial health more qualitatively. Starbucks has historically been seen as an earnings machine, right? Just consistently profitable. But the recent numbers show some strain.
Definitely showing signs of strain. That second quarter of fiscal 2025 was rough. A sharp 590 basis point drop in operating margin, a 50% decline year over year in GAAP earnings per share.
Ouch. What caused that?
Mostly those negative comparable store sales, fewer transactions, and also increased investments they're making, presumably part of Niccol's plan. Net income has been, well, notably volatile lately. not the smooth upward curve people got used to.
What about key quality ratios? Things like return on invested capital.
Right, ROIC. It's currently sitting at a healthy 13-15%. Now, historically, that's actually a meaningful decline. They used to consistently be above 25%.
So still good, but not as good.
Exactly. It reflects the increased capital intensity needing to spend more on stores and tech and that margin compression we talked about. But, to be fair, 13-15% is still way better than the average restaurant industry ROIC, which is down around 4%. So, still superior.
And cash flow. Are they still good at generating cash?
Yes, their free cash flow conversion is still strong and reliable. It's been in the 78% to 92% range in recent years. They're still very good at turning accounting profits into actual cash. That's a definite strength.
Okay, but the balance sheet, you mentioned debt. The analysis pointed to a concern there. Their main leverage ratio, net debt to EBITDA, is around 1.84x. That doesn't sound too alarming on its own, does it?
1.84x is generally seen as prudent, manageable. You're right. It's not a red flag in itself.
So what's the hidden constraint?
The hidden constraint highlighted in the report is their negative shareholder equity, a deficit of about $7.45 billion in fiscal 2024.
Negative equity. How does that happen?
It's largely the result of those aggressive share buybacks over the years, funded partly by debt. Essentially, they've returned more capital than they've generated in net income over time.
And why is that a constraint now?
Because this leveraged balance sheet adds pressure to Niccol's big fixed turnaround. He needs to make investments, right? In labor, in technology, in store equipment to fix that factory. Those investments are necessary, but they're going to squeeze margins further in the short term.
Okay.
So it creates this tricky situation. If the turnaround ends up being more costly or takes longer than the market expects, management might face a really difficult choice. Do they cut back on those essential investments, which could hurt the fix itself or even damage the theater experience further?
Whoa.
Or do they consider cutting the dividend, which would likely be catastrophic for how the market views the stock, given its history as a reliable dividend payer? It just reduces their financial flexibility at a critical time.
Okay, that makes sense. It raises the stakes on Niccol's execution. So let's bring it all together now. The bottom line, the price versus the value. As of, say, late June 2025, Starbucks is trading around 33 times its trailing 12-month earnings. Price to free cash flow is maybe 38x to 50x, depending on how you calculate it. What does that valuation tell us?
Well, putting it in historical context is key. That 33 times PE ratio, it's noticeably below where Starbucks has traded historically. Its 5-year average PE was more like 47, 49x, and the 10-year average was around 38x.
So cheaper than it used to be.
Relatively speaking, yes. It suggests the market is definitely pricing in these near-term challenges, the traffic slowdown, the margin pressure, but it's still trading well above the average PE for the broader market. So investors still clearly view Starbucks as a premium quality business, despite the current headwinds.
So the judgment from the analysis we read was something like demanding but not prohibitive.
That sums it up well. It's not obviously cheap. There's no significant margin of safety baked in at these levels. Buying the stock now isn't really getting a bargain. It's more like placing a wager.
A wager on what?
A wager on Brian Niccol successfully executing this turnaround, on him successfully balancing the theater and the factory, and on the long-term durability of that economic moat we discussed.
Okay, looking ahead then, what are the main engines for future growth? Where is it going to come from if this turnaround works? 2
primary drivers, really. First, international store growth. We mentioned that ambitious plan. Get from 38,000 stores now to 55,000 by 2030.
8 new stores a day.
8 a day. China is a huge centerpiece of that strategy. They're targeting 9,000 stores there by the end of 2025 alone. India, Southeast Asia are also key growth markets.
So geographic expansion is number 1. What's number 2?
Digital engagement and loyalty. That goal to double the global Starbucks Rewards members from 75 million to 150 million within 5 years.
Why is that so important for growth?
Because those rewards members are stickier, they visit more often, and they tend to spend more per visit, that higher average ticket size. So more members should translate directly into higher sales.
Makes sense.
Yeah.
But growth always comes with risks. What are the potential permanent impairment risks, the things that could really derail the story long term?
Yeah, there are a few big ones to watch. The most insidious, perhaps, is brand dilution. Meaning, if they focus too much on operational speed and throughput, if the factory completely overwhelms the theater, does Starbucks risk becoming just another fast food coffee chain in consumers' minds?
And losing that premium perception.
Exactly, which would eventually erode their pricing power and those high margins. That's a core risk. Then there's the existential threat, you might call it, of failure in China. It's such a critical growth market for them, but they face fierce competition from digitally native, lower-priced rivals like Luckin Coffee. If Luckin continues to gain ground and Starbucks can't maintain leadership there, that's a huge blow. Luckin is almost a pure factory play, challenging Starbucks directly on that front.
Okay, brand dilution, China. Anything else?
And finally, you always have to consider a potential secular shift in consumer preferences. Maybe people move away from premium coffee towards energy drinks, or maybe more people embrace making fancy coffee at home, or even health trends impacting those high-sugar specialty beverages that are so profitable for them. Any major shift like that could pose a long-term risk.
Right. Those are big picture risks. Now, this is where we get into what the analysts call second-level thinking, trying to think beyond the obvious. The market consensus right now seems to be, what? Cautious optimism.
Yeah, largely cautious optimism, I'd say. There's a lot of focus on Brian Niccol. He's seen as this sort of celebrity CEO, the turnaround expert. The bet is that he can apply his playbook from Chipotle and fix the operational problems, the headwinds.
The stock jumped when he was announced, right?
Yeah.
Reflecting that belief.
It did. The market clearly voted with its wallet, believing he could fix the factory.
Okay, so that's the consensus. What's the potential contrarian insight here? The thing the market might be missing?
Well, our contrarian thought, based on this analysis, is that the deeper risk isn't necessarily that Niccol fails to fix the operations. The bigger risk might be that he succeeds too well, but in a way that inadvertently destroys the intangible stuff.
The magic.
Exactly. The emotional connection, that third place magic, the theater, the very things that justify the premium brand in the first place. The market is laser focused on fixing the factory. But what if hyper-optimizing the factory leads to the slow death of the theater?
That's a provocative thought.
And to really challenge our own thinking, we should apply the red team challenge, right? Invert the bull case. Meaning, what if we're wrong? What if the whole third place concept is actually kind of anachronistic, outdated? What if the modern consumer, deep down, really does prioritize speed and convenience above everything else?
So in that scenario,
Niccol wouldn't be destroying the brand by focusing on the factory. He'd be correctly evolving it for the modern era. And the mistake would be ours for clinging to an old notion of what the moat should be. It forces you to question your assumptions.
That's a really interesting counterpoint. So ultimately, we're left circling back to this fundamental tension, aren't we? Can Starbucks successfully optimize its factory for speed and efficiency without destroying the unique theater experience that built its premium brand and earned decades of loyalty?
That is the crux of it. And maybe a final thought for you, the listener, to mull over. In our increasingly digital, sometimes isolating world, is that physical third place becoming a relic? Or, counterintuitively, does its value actually increase as people crave genuine real-world connection more than ever?
The place would just be.
Yeah. And how might Starbucks' current strategic pivot, this big bet on operational efficiency, ultimately reshape not just its own business, but maybe our very understanding of what a coffee shop can or should be in the 21st century? Something to think about.